What could spell the end of the gold rally? We'll discuss that in this video, even though for some it may be blasphemy. But we're going to discuss it anyway as we explore. You know, it's hard to imagine after gold has gone up for so long, more than doubling in price since 2022 and reaching an all-time high when adjusted for inflation, there doesn't seem to be much sign of it going backwards. Nonetheless, that is something that is quite possible according to a German publication. And honestly, some of what's mentioned here is a warning sign that we should all take as physical gold holders, because the vast majority of gold that's bought is done virtually. I'll explain that in a moment. Nonetheless, Summit Metals is a place where you can buy it physically. That's right. Physical precious metals, I think, is the premier way to hold it, the metal, because you're doing it as a long-term proposition. Because gold is rare, much more rare than silver. And so when you think about what central banks are doing, they're holding the physical. My friends at Summit Metals, they want you to elevate your wealth yourself. And you can do it through them and experience their great customer service. And yes, they do still have some competitive prices on some of their products, but shop around and experience it for yourself, and their fast shipping as well. Link is in the description below. Now, what is this talk about a bubble bursting for the rally? Well, you know, I tell you, it almost seems like it would be like a curse on the gold market, but I don't think so. This is just someone's opinion, but nonetheless, I think there's something to this that caught my eye that I think is quite interesting. Investors are turning gold into a speculative asset by flooding gold markets with billions in capital, increasing the risk of becoming victims of their own success. And let's talk a little bit about what's driving the boom originally. There's where I disagree to some extent, although they are interviewing somebody who is associated with a very, very respected gold precious metals firm. For Nikki Shields, the current gold rally, which saw prices virtually explode in recent months, is an indication of very little trust in the system. There's less trust in government, less trust in the functioning of society, the head of Precious Metals Investment Strategy at MKS PAMP Group told DW.com. Now the emerging question was whether the relatively small gold fund market could absorb the current flood of capital. Based in Geneva, Switzerland, MKS PAMP Group is one of the most influential players in the global precious metals industry. It processes gold, silver, and platinum into bars, coins, and products for jewelry and industrial companies, and offers investment products for both institutional and private investors. According to the World Gold Council, global assets under management in so-called gold exchange-traded funds, which are known as ETFs, rose from $472 billion in September of this year to $503 billion in October, which is when gold reached its all-time high. That is a 6% increase month over month. It's pretty remarkable. Inflows for October alone amounted to $8.2 billion, well above the previous annual average of $7.1 billion. In the third quarter of 2025, from July to September, physically backed gold ETFs recorded a record inflow of $26 billion. It is mind-boggling how many people are getting into gold, but really mostly virtually through these exchange-traded funds. North American investors led with $16.1 billion in gold ETF investments, while European funds also saw strong buying, reaching the region's second highest quarterly figure with $8.2 billion. Gold ETFs track the price of gold without requiring investors to buy and store physical gold bars themselves. Many of these ETFs are actually backed by physical gold held in vaults and assigned to fund assets, which is why they're often called paper gold. And also, they may be backed by it, but there's many more derivatives in that market. In fact, I don't know what it is for gold, likely 100 and some odd paper ounces for every ounce of physical gold, which means that it would never really be called for delivery. They will not take delivery because it would completely crush the entire system if they did. If everybody who bought them, the paper versions of those electronic ETFs, and they expect to get gold back, it's not going to happen. And which means that even though it's backed by physical gold, it is not physical gold itself. It's merely exposure to the price of gold. Unlike stock funds, gold ETFs consist of only one component, and that is gold. But remember, it is the exposure to gold's price. That is it, gold's price. I have to tell that because so often people think, well, I've got gold in my portfolio. Yeah, you've got the price, you've got an exposure to the price, but that's it. It's not physical gold itself. Unlike stock funds, gold ETFs consist of only one component. This means they do not diversify investment risk across multiple assets. And because of that, they're not actually approved in Germany. And Germans have ETCs, which are exchange-traded commodities, which are securities for exchange-traded raw materials. Basically, something else with a different name. But anyways, market analyst Martin Seigert of German regional lender Landesbank Baden-Württemberg expects the gold rally to continue. Many of the key pro-gold arguments remain valid. According to the bank's platform in late November, inflows into gold ETCs are likely to remain intact. He expects interest rates in the United States to keep falling, raising more questions about the future independence of the U.S. Federal Reserve and the stability of the U.S. dollar and U.S. trade policy that will probably continue to surprise markets well into 2026. And against this backdrop, their forecast for gold has now risen to $4,600 an ounce. The previous all-time high for gold was reached in October this year with about $4,350 per ounce. Right now, it's sitting above $4,200. In September, U.S. investment bank Morgan Stanley even advised investors to change their portfolio structure to make gold a core component. Instead of allocating the traditional 60% to stocks and 40% to bonds, some 20% of investments should go into gold products, the bank said. Others have suggested 35% into gold. But remember, that is not physical gold itself. And I'm encouraging people to actually buy physical gold, and maybe even more so than these ETFs. And so high-quality equities and gold are the best hedges, according to Mike Wilson of Reuters. Gold is now the anti-fragile asset to own. The British Business Daily Financial Times recently described the hype as being stoked by gold-plated FOMO, noting that investors fearful of missing out on returns and worried about inflation add the precious metal to their portfolios, fueling to what's becoming the biggest gold price rally since the 1970s. And people should not buy out of fear, even in times like this. However, having the physical gold in your possession means that you're more committed to it. It is not as liquid as a click of a mouse button. And you also should understand that it's not really meant to be as an investment. And even though it's trading at all-time highs now, likely it'll probably continue to surge forward. But the bubble could burst. I'm going to get into more detail on what that means here in a moment. We have capital inflows in the gold ETFs that are driving the rally into gold. And Tether is also playing a major role. You've heard me talk about that they have accumulated supposedly about 100 tons of gold. Now the world's largest digital asset company based in El Salvador and issues a Tether stablecoin is designed to maintain a stable value, is being pegged to an external asset like fiat currency such as U.S. dollar. And now they are promoting investment to its Tether gold coin, which is pegged to the value of physical gold. So that is another aspect that they're doing. But remember, you're still not buying gold when you do that. MKS expert Nikki Shields thinks that amid the overheated gold market, the commodity, long seen as a safe haven, has itself become a target for speculation. That's right. This is what happens, especially when you get into a bull run that's fairly extended like what we've seen. People tend to speculate in it. That's the danger. That's where the bubble could burst. Through the last 2 months, it has been in a very bubble-like territory, he says, with not just gold and silver, but U.S. stocks. The market is overheated, she told DW. For Shields, the overheating has several causes, including the fact that the U.S. Fed has been cutting interest rates even though the U.S. economy is not in a technical recession. There are cracks in the U.S. economy, cracks in the labor market. Housing isn't so great, but we are cutting interest rates, creating more availability and more liquidity into a system that does not perhaps need it. But one thing it will create is inflation, which could actually be good for gold long term. But short term, with that injection of liquidity, it could spell the end of the rally for now. Now, what would that mean for gold's prices? Well, it doesn't say in this article, but I think that probably we could see gold's prices maybe even plunge 3, 4, 5%, and if not more than that, before they pick back up again. Remember, this is something that I've learned. Recession or not, well, recession as well. Usually we don't know what we're in a recession until about the next time the numbers comes out. We really don't know that it's happening. But usually what happens in a recession, at the tail end of that recession, we see prices go up. Same thing with inflation. Those are lagging indicators, and the gold's price is a lagging indicator of that. Because people, they're looking for dollars, they're looking for injection of liquidity. They're going to use dollars for that, for whatever they need. For in a low interest rate environment, there's not much there's less competition with gold, but it also means that money is being used and lended out for loans with low interest rates. So that can work against gold. And so that's what we're seeing here. Over the past 10 years, it's been a decade of very loose financial conditions. Shields said this has created a lot of bubble assets. And this is something that we're seeing happen and being infected not just with U.S. stocks, but now with gold and silver even more recently. In some ways, this applies maybe even stronger to silver. But I think gold has been in a rally for longer, and there could be a situation where gold takes a back seat and falls, and silver maybe continues to climb in this environment as people look for an asset that still has room to move up, and people see the top of the market for gold. So it's very difficult to ascertain here, but remember, the shock is how much money is in the gold market that is not into actual physical gold. So this is what we're looking at here, and when you start to speculate, the asset you're speculating in becomes a speculative asset, which is exactly the opposite of what gold should be. This is all the more reason why to hold the physical. And I'm holding through the highs and holding through the lows. I believe in holding gold for the long term with a closed fist, a tightened fist. That's a diamond fist having gold in your possession. Gold, get you some and hold you some. With that being said, I'd like to extend a multitude of gratitude to each and every one of you for taking the time to watch this video, and to encourage you to please rate, share, comment, and subscribe.